What's up, NeXtGenBulls? Dennis here, and today we're going to be talking about charting. Now, if you're new to trading or thinking about trading, chances are you have been looking at a lot of charts, maybe out of curiosity or to try to interpret what a stock or cryptocurrency is currently doing. For active traders, looking just at the stock price is not simply enough. Traders read and analyze charts to help them come up with a bias or belief on what might happen next with the price action of the stock. In this video, we are going to be going over the basics of candlestick charts. To better understand how you, as a trader, can use candlesticks in your trading, let's quickly brush up on how to read a stock or crypto chart. Stock and crypto charts are known as a type of Cartesian graph. They all present the history of price and volume over a period of time. Here is a very typical stock chart for Microsoft. Down at the bottom here on the x-axis is time, and over here on the y-axis we have price. The graph we are viewing here is presenting our price over time data in the form of a line, also known as a line chart. This very common type of chart typically tracks the closing price over a specified period of time, as we can see here as we hover over the different points on the chart. The time frame on this chart is tracking the closing price of each passing day. This time frame is commonly known as a daily chart. A good chart will also display the volume for that specified time period, which is typically found on the bottom of the chart. The volume will present the level of trading participation there was for that time period. Volume is a popular indicator many traders use to gauge if a stock or cryptocurrency's trading participation is above average, below average, or just average for that time period. If the stock or crypto is experiencing higher than average trading volume, traders may be motivated to participate in the action, as higher than average volume typically comes with volatility in the stock's price action, which is desired for day trading or scalping. There are many different ways stock and crypto charts present price over time data. As mentioned earlier, the most common presentation is in the form of a line. But there are also other popular charting data points such as Western bars and of course candlesticks. So, what is a candlestick anyways? A candlestick, also known as a Japanese candlestick, is essentially a form of charting that presents 5 points of data of the underlying instrument, whether it be a stock, cryptocurrency, forex pair, or futures contract. These 5 points of data presented by candles are the open, close, low, high, and range. There are also two types of candles. You have an up candle and a down candle. An up candle is when the closing price is higher or greater than the opening price. A down candle is just the opposite. The closing price is lower or less than the opening price. Up candles and down candles are presented in different ways depending on the chart or broker you are using. Universally though, a shaded candle will be a down candle, while a hollow candle with no shading will be an up candle. With today's modernized broker platforms, up candles will typically be green, while down candles will typically be red. Let's further break down the anatomy of a candlestick. Let's start with the popular candle for most traders. Looking at this up candle, we see the open and the close. The open and the close are found on the body of the candle, also known as the real body. The high and low are located on these wicks, or shadows, as some traders call it. The high will be presented on the upper wick and the low on the lower wick. The difference or distance between the high and the low price is called the range, which, as the name implies, it is the price range for that time period. An important note, not all candlesticks have wicks. There can be times when the open could serve as the high price for the period. Let's go look at some examples. Here we have chart of cryptocurrency XRP. The time period set on this chart is daily, meaning every candlestick you see here represents 1 day or 24 hours, since cryptocurrencies trade 24/7. Let's focus on this green candle right here. The time period for this candle is for February 13th. The open, high, low, close is presented up here at the top. The only data point not presented here is the range of this candle. But that's not a problem. We now have the knowledge to figure this out. The high of the day was 64 cents and the low was 54 cents. The difference in price here is 10 cents. XRP opened at 61 cents and closed at 63 cents on February 13th. Here we have the daily chart on Tesla. Notice how this green candle doesn't have an upper wick. This means that the closing price was also the highest price Tesla traded at for this day. Even without an upper wick, we can still determine the candlestick range. In this case, we take the highest price of the day of $695, which is also the closing price, and get the difference from the low of the day, which is $628.54, giving us a range for the day of $66.46. Now, to please some of the next-gen bears out there, let's take a quick look at this down candle on Southwest Airlines. This is quite the down candle here on this daily chart, but the same principles as before still apply. Being a down candle, we have the open, close, high, and low. We have the high on this long upper wick and the tiny little lower wick for the low of the day. What is the price range for this time period? If you answered $5.68, you are correct. With all this new knowledge, you now might be asking yourself, how practical is reading candlesticks when it comes to trading? Is it even necessary? My answer is yes and no. For those who truly want to take their trading to the next level, understanding how to read and interpret the data presented by candlesticks is necessary, especially when you start using technical analysis in your trading. What is technical analysis anyways? You might have heard of the term before, or it might be brand new to you. Technical analysis is the discipline of forecasting future price based on the study of past and current price market action. This practice is founded upon the idea that studying the past behaviors and patterns of an underlying asset allows traders to develop a reasonable forecast on what the asset is likely to do in the near or distant future. Now, in layman's terms, history tends to repeat itself when it comes to trading. By studying candlesticks, their patterns, consulting indicators, reading price pivots, price ceilings, price floors, and trends, to name a few pieces of data, traders use these studies to form an edge on their price forecast. Chart reading and candlesticks play a fundamental role in technical analysis, and by understanding candlesticks, you are already one step closer to using technical analysis in your trading system. If you are more of a buy and hold trader, or maybe just holding an asset as an investor, reading day-to-day candlesticks isn't necessary, as the closing price for each time period may be more than sufficient data that you require. However, if you want a better graphical presentation on what your investment is doing, consider enabling candlesticks on your trading platform. Alright traders, this was a basic 101 video on how to read candlesticks. If you got any value out of this video and want to learn more about technical analysis, smash that like button to the moon and consider subscribing for more educational videos and other trading related content. This is Dennis with NeXtGenBulls, signing out.